Stephen Schwarzman is a businessman, philanthropist, and the current chairman and CEO of the Blackstone Group, the largest investor in alternative assets and one of the most profitable finance companies in the world. In 35 years, Blackstone has been transformed from a boutique advisory firm into a global private equity business that manages more than $670 billion, managing money for a number of institutional investors around the world. Blackstone invests into a number of asset classes, with many of their investments made into real estate, energy, and infrastructure, which rarely make big headlines. Let's take a look at how Steve Schwarzman built Blackstone to become the most powerful man on Wall Street. Stephen Schwarzman was born in Philadelphia in 1947 to Joseph Schwarzman, a dry goods store owner, and his wife Arlene. As the oldest child born into a Jewish family, his parents expected him to get everything right. At the age of 5, he started working in his father's retail business, but he decided against it after being forced to wait on customers and fold up goods for them. Despite not wanting to join the business, he tried to persuade his father to develop the standalone store into a national chain. Unsurprisingly, his father refused, suggesting that he had a good life and could afford to send his children to college, so did not follow the idea. At school, Schwarzman was a good performer, often finding himself near the top of the class, but that meant that others were always better than him. His first taste of entrepreneurship came when he set up a lawn mowing business which employed his younger twin brothers. They did most of the work, and he kept half the money. After graduating from Abington High School in Philadelphia, Schwarzman attended Yale and majored in psychology, anthropology, and biology. While applying for jobs at college, he had an interview with Pan Am, the largest aircraft company in the world. During the interview, Schwarzman suggested that they buy up all the excess planes from the Vietnamese War and go into the cargo business. The interviewer told Schwarzman that it was not his job to think about things like this, but other companies did adopt a similar strategy, which became very successful. Unsurprisingly, Pan Am didn't hire Schwarzman, and he did not have a job after graduation. After a chance meeting of an admissions manager of a small finance firm at a local picnic, Schwarzman was introduced to a number of high-flying business executives in New York. One man he was introduced to offered the young Steve a job, but recommended that he didn't take it. He said that Schwarzman was too smart to work for a Wall Street bank and recommended that he go to a small firm full of smart people. Otherwise, he'd be very unhappy. Soon after, he met Bill Donaldson, who ran a small investment bank in 1969, who offered him a job. After 6 months in the Army Reserves, Schwarzman went to Harvard Business School to educate himself in the world of economics and accounting. He wanted to drop out, but Donaldson, who now was his mentor, told him not to, based on his previous experience. After graduating from Harvard, Schwarzman had a number of job opportunities, but he decided to join Lehman Brothers due to the interesting characters in the firm that included an ex-CIA agent and people who had previously worked on oil rigs. He recognized that corporate finance would be his long-term career, as it required problem-solving to constantly changing issues, something that suited him. At the tender age of only 31, Schwarzman was a partner at Lehman Brothers, running their mergers and acquisitions business. However, after the company was acquired by American Express, it came into financial problems, prompting Schwarzman to leave. Had the company not been taken over, Schwarzman would have stayed. In 1985, he and his former boss from Lehman Brothers, Pete Peterson, set out to build an investment firm of their own, now known as the Blackstone Group, with $400,000 in initial capital. They planned to start as a mergers and acquisitions specialist and then move into private equity once they became more established. He felt that investing wasn't that hard, despite only ever being an advisor. However, many of the smaller firms who had tried to break into investment banking had failed, but Schwarzman believed that Blackstone would be accepted into the industry dominated by Goldman Sachs, Morgan Stanley, and his former employer Lehman Brothers. The two partners agonized over a name for their new firm, unable to come up with one. It was Schwarzman's former stepfather-in-law who suggested that he use part of his name, Schwarz, meaning black in German, and Peterson's name Petra, meaning rock or stone. Hence the name Blackstone was born. Initially, money was tight, and many former colleagues were willing Blackstone to fail. In their second year in business, they made their most successful decision by going into the leveraged buyout business, better known as private equity. The process involves buying undervalued companies using debt, improving the company, and either listing on the stock market or selling to another company. This often involves taking large loans and replacing top management. Neither Schwarzman nor his business partner had any experience in the leveraged buyout business, but they decided to raise $50 million for the fund so that they could do smaller deals and learn how it worked. Schwarzman visited First Boston, a rival company who had $1 billion under management in their new fund. He liked the idea of having more than the $50 billion they planned under management, but thought it would be fun to do it without the people. After the visit, the plan changed for Blackstone to raise $1 billion. With unwavering self-belief, Schwarzman now felt it was the best time to be raising capital in 1986, with leveraged buyouts becoming more popular and not enough investment vehicles to meet this demand. Prudential, a major company, had agreed to invest in the deal, and that meant that many others followed. They ended up raising $950 million in total, allowing Blackstone to start with big deals. Their timing was perfect, as Black Monday occurred just after the fundraising closed. As of 2020, Blackstone has raised 8 venture capital funds, totaling just under $100 billion. Schwarzman likens the industry to a basketball player who only shoots when he is in a strong position to score, and that you only invest when you have strong feelings that the company will be successful, like when fishing in a well-stocked pond that no one else knows about. In 1991, Blackstone went into real estate during the recession. Schwarzman later admitted that he knew nothing about real estate and thought it was risky as neighborhoods could change and cause house prices to plummet. An agent offered the company an apartment block with a rental yield of 15%. After borrowing against the property, the company made a 25% return on their investment in the middle of an economic downturn. This changed the partners' mind on real estate, as they would be able to borrow more money once the economy recovered to buy more properties. They had access to the whole country, as competitors were reeling from the house price crash. Schwarzman learned more about the world of real estate after meeting Joe Roberts, a real estate salesman who teamed up with Blackstone to bid on some apartments in Arkansas. They won the auction, and after spotting other opportunities across the country, bought a number of other apartments. Aside from investing in real estate, Blackstone also made an early investment into BlackRock, the easily confused asset manager who currently manage over $6.5 trillion. They owned 50% of the firm, but sold in 1995. In 1990, Blackstone launched their first hedge fund business, partnering with UK fund manager J.O. Hambro, and created its European unit in 1991. The creation of the hedge fund business came after a client asked Schwarzman how he invested his own money, as he often worked 14 hours a day. Schwarzman explained that he put his money into a hedge fund, and the client wanted to do this too. He built a new business worth around $65 billion, where money is given to some of the world's best hedge funds as part of a fund of funds. This provides investors with diversification and access to the best hedge funds around the world with a smaller capital commitment than traditionally required. As the firm grew, so did the deals. Blackstone acquired TRW Automotive, a leading supplier of automotive parts, partook in the purchase of SunGard, an IT provider, and bought soft drinks company Orangina from Cadbury's in 2006 for $1.85 billion. Blackstone went public in 2007 for $4 billion, as Schwarzman's business partner was 21 years older than him, making it an easy way for him to sell the majority of his stake. Schwarzman also wanted some dry powder, and the 2008 financial crisis came a great time to use it. The Chinese Sovereign Wealth Fund were very interested in Blackstone and asked to invest $3 billion at the IPO. This was the first time the Chinese had ever invested in a listed company at the IPO stage outside of China. Using some dry powder, Blackstone bought hotel chain Hilton in 2007 for $27 billion just before the financial crisis. They spotted an opportunity for the company to expand internationally and bought in. Blackstone cut the costs by integrating the 4 US headquarters into one and opened more hotels across the globe. Once the economy recovered, Hilton was sold for a $14 billion profit. Blackstone survived the 2007 real estate crash after buying a $39 billion real estate business, which is still the largest ever real estate deal recorded. They managed to sell half of what they bought the same day to reduce their risk. This was done by breaking down holdings into smaller pieces and selling to smaller investors, many of whom went bankrupt as the prices crashed. Blackstone ended up with only a quarter of their initial investment and made 3 times their money once the prices recovered. Since the financial crisis, Blackstone have acquired a number of notable companies as investors have flocked to private equity. These deals include Leica, the upmarket camera brand, fashion brand Jack Wolfskin in 2011, Magic Lab, the parent owner of Bumble, and the UK's largest ever private equity buyout for IQ student accommodation for $6 billion in 2020. When asked about his biggest mistake, Schwarzman did not invest in Bloomberg. Michael Bloomberg, the founder, came to see Schwarzman looking for outside investment of $100 million for around 20% of the company. However, Bloomberg had one stipulation. He could never sell the company and Blackstone would have to stay invested forever. Schwarzman refused as he could not sell the investment easily and return the money to his investors. Bloomberg is now valued at around $30 to $40 billion, which would have netted Blackstone around $8 billion. While it is easy to focus on the successes, private equity is notoriously high risk. If the company goes bankrupt, all the investors lose their money, something Blackstone has experienced on a number of occasions. As recently as February 2021, Blackstone backed a Mexican-based natural gas plant that filed for Chapter 11 bankruptcy with debts of over $800 billion, highlighting the problems of debt that private equity firms inflict on companies. In 35 years, Schwarzman has transformed Blackstone from a boutique advisory firm into a global private equity business that manages more than $670 billion. In 2020, Schwarzman made $615 billion, mainly from dividends, and has a net worth of $22 billion, according to Forbes. At the age of 74, Schwarzman has no intention of retiring, suggesting he would only stop if he wasn't any good. He has certainly had a successful career that many would love to emulate.